Thanks for joining us today on The Close. I'm Morella Fernandez. Markets close in 30 minutes, and we're looking to close out the week with a mixed picture for North American markets as gold's rebound boosts the TSX and the tech worries over Google's Anthropic weighs on the NASDAQ. After tumbling earlier in the week, gold is rebounding to end the week with a 1% gain. Let's get to Bitcoin as well. That continues to see selling pressure as the cryptocurrency is set to close out the week 17% lower. Let's get to some of the other stories we're following in the BNN Bloomberg newsroom. Canada's economy lost about 25,000 jobs in January. Economists had been expecting a gain of 5,000. StatsCan says the manufacturing sector was hit hard with U.S. tariffs continuing to weigh on the industry. January's job loss marked the steepest decline since August of last year, but the unemployment rate actually fell to 6.5% because fewer people were looking for work. Shares of Stellantis down sharply today after the automaker said it's taking a $25 billion write-down linked to its shift in EV strategy. Stellantis is also selling its stake at a battery manufacturing plant in Ontario to LG Energy Solution. The plant was established in 2022, and under the terms, LG will hold full ownership of that facility. We are watching shares of Canopy Growth today. The Canadian cannabis company posted net revenue and profit for its third quarter that did come in above expectations, revenue hitting $74 million. Canopy says the results were driven by strength in its Canadian market as well as cost-cutting initiatives. On the downside, international markets revenue fell 31% from the year before. And shares of Open Text are trading almost 9% higher after the Canadian software company topped profit and revenue expectations for its latest quarter. Cloud revenue also came in above estimates and saw an increase of about 4% from the year before. The quarter also got a boost from better than expected revenue in the company's content management unit. So here is where we are on the markets right now, a 397-point gain today for the TSX. It's up 1.25%. And in the U.S., the S&P 500 up 123 points or 1.8%. The Dow Jones gaining 2.3% today, and the NASDAQ has a 2% move up so far, 449 points up. All right, as mentioned, the Canadian economy lost 25,000 jobs in January, manufacturing accounting for much of that decline, but the unemployment rate did ease to 6.5%. Let's go to Sal Guattieri, senior economist at BMO Capital Markets, for some more insight. Sal, thanks for joining us today. Fewer people looking for work, but is that a result of lower immigration or other factors?
Yeah, the drop in the unemployment rate is largely related to just fewer people searching for a job. We know the labor force growth is slowing because of the aggressive immigration curbs and the general slowing of the population growth. So that is really the main reason the unemployment rate dropped in January. It wasn't because more people were getting hired, finding work, and that's quite unfortunate. And overall, even though there were a lot of moving parts in this jobs report, it really is a bit disappointing to see the 25,000 drop in employment for that month. Now, mind you, it is coming off a string of pretty solid gains towards the end of last year, and all the losses were in Ontario, which did face a pretty significant snowstorm in the month, so that may have been a factor. But overall, that drop in employment is a little more consistent with what we're seeing in the other survey of jobs in Canada, the establishment survey. That's been quite weak for some time now, and basically telling you a more consistent story with what the GDP numbers and other economic data are suggesting. And they're really just telling us that Canada's economy probably has avoided a recession, but it's still growing very modestly, and it's really struggling to get ahead of this trade war because of the ongoing uncertainty tied to trade policies.
Okay, so I do want to ask you about manufacturing, where we saw that big drop off. I'm just wondering why you think we saw this change now. Is it just start of the new year and maybe some of these companies weren't able to hang on anymore?
Well, it's not just the drop in manufacturing jobs in January. That's been a consistent theme right through the trade war now. It is the manufacturing sector that has lost more jobs than any other sector in Canada in the past year now. I think over 50,000 jobs in total. So no surprise, we're seeing job losses in the auto industry in particular, and most of the industries impacted by tariffs are seeing layoffs. Now, thankfully, we're not seeing more widespread layoffs in other sectors in Canada. The weakness is, for the most part, contained to the factory sector. But again, that's not going to be a source of job creation for quite some time until we get by a lot of the uncertainty tied to trade policies, in particular, until we get well into renegotiation of CUSMA and get some clarity there on where tariffs are ultimately going to land here in Canada.
Do you then anticipate a further weakening of the labor market, especially because those negotiations aren't likely to happen until sort of mid-year, sometime in the summer?
Yeah, unfortunately, even though negotiations for CUSMA will not, they've already began to some extent, but officially don't need to begin until mid-year, they may take a lot longer than that to come to some agreement and rewrite the overall agreement. In fact, our main assumption is that we do not see an end to those talks this year. We could see a series of annual reviews that extended to next year, even 2028 or beyond, before they finally come to an agreement and decide to extend the agreement for another 16 years beyond 2036. Unfortunately, that does mean that a lot of the uncertainty tied to trade policies will continue to hang over the heads of Canadian businesses, will discourage business investment and even some hiring in this country. Now, hopefully, we will get some clarity, maybe even some relief on some of the high tariffs on steel, aluminum, motor vehicles through these talks. That would come as some relief. But again, we're not assuming we see a full rewrite of the CUSMA this year.
From what you've seen with the employment numbers today, is that enough to have you look ahead to a Bank of Canada changing course sometime this year?
Yeah, I think there's so many moving parts in today's jobs report that it really is mixed enough that it doesn't move the needle for the Bank of Canada's next policy decision in March. They'll take some comfort from the fact the unemployment rate fell, but again, not for a great reason. You just have fewer people looking for a job. That's not the way you want your unemployment rate to fall. I think, if anything, the Bank of Canada will be a little concerned by the decline in employment at the start of this year, and the fact that it's confirming other surveys, labor market surveys, that suggest job growth has been very weak in this country, consistent with a sluggish growing economy. Now, the bar for the Bank of Canada to do anything policy-wise is pretty high. They're pretty comfortable with where policy rates are right now, mildly stimulative for the economy. And unless they see the economy turning downwards, it's very unlikely they will opt to cut interest rates further. Now, at the same time, we think the bar is even higher for them to raise interest rates, again, largely because of all the uncertainty tied to trade policies, until we get some clarity there, which may not be into next year. I very much doubt the Bank of Canada will be keen on raising interest rates. So we just see the Bank of Canada on hold well into next year.
All right, Sal, I got to leave it there, but thank you for your time. Sal Gualtieri, Senior Economist, BMO Capital Markets. Coming up next, we'll have a look at the markets. North American indexes rebounding today after what has been a very volatile week. We'll take you deeper into it when we come back. North American markets rallied back after being dragged down by tech stocks this week. Let's go to Sébastien McMahon, portfolio manager at IA Global Asset Management, to talk about this. Thanks for joining us. The TSX rallying back, still off the highs of January. Are investors now just sort of jumping in on the opportunities it's presented?
We were expecting risk on markets this year. We're expecting pro-cyclical kind of returns with the tailwind coming from synchronized rate cuts over the last few years. That means commodities doing well. That means equity is doing well. So, we're seeing emerging markets first, Europe second, TSX third. I mean, we're not surprised to see this kind of action. So it's value over growth, it's cyclicals over tech. So yeah, only 5 full weeks into a very eventful year, but so far so good for our thesis here.
Are you buying back into tech in the U.S.? Some of that has been depressed, of course, this past week.
Well, maybe it's a bit too early to go bottom fishing. Software, for example, is being repriced quite aggressively. Software as a service and consultancy firms with agentic AI. Those are very high margin businesses that are being attacked right now by agentic AI. Market maybe seem to be pricing the worst case scenario when we're reading numbers about $24 billion of hedge fund shorts on these names. But, maybe the real story is the contagion risk that we're seeing in private credit right now. Blue Owl and Aris, are deep into those loans. Those loan software-backed loans were once viewed as exceptionally stable. Now maybe this is being revised. So maybe too early for bottom fishing. Maybe play the market rotation towards cyclicals.
Okay. You see, as you mentioned, a stronger case for commodities this year. But how much of a risk comes from that renegotiation of the trade deal?
Well, the trade deal is going to be the big issue this year. We don't have any more information yet, but we still think that the Canadian economy could be benefiting from this risk-on tone. In the U.S., the ISM manufacturing index coming out earlier this week showing that, production is up, new orders are up. The inventory cycle also should benefit here from, new orders by manufacturers in the U.S. They should be importing more from Canada as well. So, nothing extraordinary, but still a risk-on environment, which should be helpful for commodity complex, and that should be helpful for the Canadian economy. But more importantly, the TSX likely is set to outperform. We still think it's going to be about 15% this year for the TSX versus 10% for the S&P 500. So we haven't changed our mind there.
Okay, base metals showing strength. What about precious metals, which have been on a run, but also been more volatile recently?
Yeah, precious metals. I mean, it's hard to call the price of gold these days. I mean, what's the fair value on gold? I mean, it's hard to put a number on that. We would say maybe a consolidation here is likely, but where the opportunity is in gold miners, is in base metal miners, copper miners in Canada. If we're in a world where prices on average are quite elevated versus what they were a few years ago, of course, those margins will go higher. Production costs have not risen that much. And when I'm talking to my colleagues who do the stock picking there, they do see ample value in the valuation of the commodity sector, the commodity producers, the gold miners, copper miners. So that would be the place to be.
Okay. Your top pick right now is XPO, which is a play on transportation out of the U.S. Tell me about it.
Yeah, sure. So market this week has been focusing on the AI losers for the first time, but this here seems to be one of the first AI-driven margin expansion plays. This is in trucking in the U.S., so an LTL play. It's among the first true AI adopter plays, and AI driving real cost savings. For example, they've had a 12% reduction in empty miles already by using AI. And if you believe the stronger 2026 macro story, you're looking at higher freight volumes and higher pricing power here, especially in a sector where there's a structural deficit following Yellow Corp's bankruptcy. There's always the USMCA risk, but they are a bit spread out through North America, more towards Mexico than in Canada. But we do feel that it's an interesting story. It plays with our macro thesis, but the AI adoption theme here, real productivity gains, that's an interesting one. Already 35% higher in the month, but our teams think that there's much more upside than that.
Okay, so I'm wondering if you think transportation is going to be one of the first adopters to gain those efficiencies. Sometimes we talk about financials and that backroom work being picked up by AI, but you think transportation more widely could pick up here?
Yeah, it's certainly looking like that. When you look at the sector breakdown, who's adopting AI and where are we seeing growth, we're seeing a real impact. Well, trucking, surprisingly, maybe is at the top of the list. The logistics of trucking, the dispatch of those routes, it's very important, and you can make real savings quite rapidly just by using AI to better dispatch the work from trucking. So we're seeing good gains there. Financials and, interestingly, big tech are where we would be expecting to see gains from AI, but they are still elusive. So it's in the real economy that we're seeing gains.
All right, Sebastien, we'll leave it there, sir. Thanks for joining us. Have a good weekend.
Thank you.
Coming up next, first round of negotiations in Oman between Iran and the U.S. concluded today. We'll tell you what happened and get into the details when we come back. Indirect talks between the U.S. and Iran have concluded in Oman. Both sides continue to seek an agreement on Iran's nuclear program. But the U.S., of course, has increased its military presence in the Middle East as tensions escalate between Washington and Tehran. Let's go to Arman Mahmoudian, research fellow at the Global and National Security Institute, to talk some more about this. Thanks for joining us today.
Thank you for inviting me, Marla.
Are you at all hopeful that the talks will bring about something concrete?
It's very hard to say, and to be honest, the circumstances for a deal or reaching a mutual understanding is not necessarily the best, because Iran is entering this negotiation at its most vulnerable stage. Iranian, both domestically and foreign, regionally, are vulnerable, are weak. They've been weakened by the aftermath of the Israelis' attack on Iran's proxy networks, by the Israeli and American attack against Iran's defense and nuclear facility in June war, and then the protests. And when a country enters a negotiation with such circumstances, they are usually demanded or required to make the most concession and compromise. And at least that's the speculation about how the United States, or what the United States wants out of this negotiation. But the problem over here is that things that the United States is asking or may ask, including the halting Iran's enrichment program permanently, is going to be very hard for the Islamic Republican regime in Tehran to forego. We have to keep in mind Ayatollah Khamenei, the supreme leader of Iran, has turned the matter of the enrichment of the uranium and, generally speaking, the nuclear project as not part of only his regime identity, but as its own identity. As in the last 3 decades, he's been emphasizing this is an absolute right, non-negotiable right, and Iran must have it, Iran shall have it, and Iran will have it. So compromising and making a concession that forgoes from such a program would come at a great deal of political cost and political capital for him personally and for the establishment.
Okay. Let's talk about whether you see even room for some sort of concession on nuclear. You mentioned perhaps they won't go to the point of saying we will cap what we have and not go any further. But would they be willing to take at least a step back?
I think there are things that the Iranians are willing to make compromise. I think right now they are willing to make a compromise on the matter of the enriched uraniums. Iran has about 400 kilograms of highly enriched uraniums, over 60% enriched uraniums, that during the June war, neither Israelis or Americans, either out of the willingness or capacity, couldn't demolish that. So that exists, and that can be materialized toward the military program quickly. So, and Americans have been very clear that they want that uranium out of Iran. I think Iranians are willing to make that compromise. They may will to send that enriched uranium to Russia or China outside of their territory, and they hold it under the consortium. On the matter of enrichment itself in Iran, Iran doesn't have any active enrichment right now because the war kind of dismantled it. That's what, at least what the Iranian foreign ministry approved, that confirmed they don't have any active enrichment, but they have a couple of thousands of the centrifuges here and there that has not been assembled or entered to the enrichment centers prior to the war that can be used, and they have the knowledge to build further. So I think what Iranian can do is to make not necessarily a written agreement, but a promise or reach a mutual understanding that they will withhold from restoring their enrichment program temporarily, not permanently, or they will have their enrichment outside of the Iran, in Russia or in one of the Arab states of the Persian Gulf under the mutual consortium. These kind of solutions have been proposed, but we never seen them either of the sides go through it or follow through it very seriously. But this time seems to be very different for both of them.
Okay, what about missiles? Would they be more open to having some sort of concession on missiles?
That's a very good question, and I think that's the most critical stage right now, because the issue of missile is actually much more severe than the issue of the nuclear matter, at least in my view, because the nuclear project of the Iran never been materialized to the extent that can be used for Iran's military capability, either defensive or offensive. Iran never had a nuclear arsenal. But the missiles have been proven since at least the previous war that they are primarily tool of Iran's defense and offensive military capability. Look, in the June war, Iranian proxies didn't take much of a role. Iranian Navy didn't take much of a role. This Iranian so-called cyber offensive campaign didn't take much of a role. It was Iran's missiles that were kind of the pioneer or frontier of the Iran response and retaliatory campaign. So imposing limits on that from Tehran's perspective would accepting to undermine their own defensive or retaliatory capability, which makes them even further vulnerable to further military strikes. But what they can do is that instead of putting a restriction on the ballistic missiles or, reducing their ballistic arsenal, I think Iran is willing to make a compromise or concession on putting a halt on the scope and the range of the ballistic missiles. In past, the Iranians were very careful to not build or not at least display any ballistic missiles that can go beyond the medium range. But yesterday, they displayed or they showed a new missile, the Khorramshahr 4, which they call it the long range, but we have to wait and see. But one thing that Iranian can do is that, they can make this concession that we will put a halt on the range of our missile. We won't build any missile that can go more than 2,500 kilometers. Is it something acceptable for the United States or not? That's a different story. But I think that's the extent of the compromise that Tehran at least is willing to go with it.
Got it. Okay. We do have to leave it there, Arman, but thank you for joining us. Arman Mahmoodian is a research fellow at the Global and National Security Institute. A quick look at the markets as we head to a break. Up next, the end-of-day numbers. TSX recovering today. So is the S&P and the NASDAQ after what has been a brutally volatile week. We're back in just a moment with the end-of-day numbers. Stay tuned for that. Here are the closing bells for the end of the trading day and the end of the trading week. At the NASDAQ, Egom Ab Therapeutics, NV, ringing the closing bell. In New York, the I Have a Dream Foundation ringing the bell. You're watching the close on BNN Bloomberg. I'm Morella Fernandez. Here's how we ended the day on Bay Street and Wall Street. The market's bouncing back today after what has been a pretty brutal week. The TSX gaining 476 points, or 1 and almost 1.5% to end the day. The S&P 500 all up today almost 2%. That's a 133-point gain. And the NASDAQ up over 2%, 2.2 about, 490 points up on the day. Let's get to the movers for the week. Now, Canada's Synopta shares are soaring today after getting a $785 million takeover offer from U.S.-based Refreshco. That sent Synopta shares up 31%, even though it's down over the year 17%. ARC Resources in headlines today reporting lower profit and higher revenue for its fourth quarter. Investors were not liking what they saw. That sent shares down 10%, each share losing $2.57 today. Let's go to the 1 week for Thomson. It is down 20%, Thomson Reuters, after Anthropic unveiled a new AI tool that some suggest threatens this kind of data business. So shares are down 77 cents to 120.18. But again, that was a 20% drop, 20.5% for the week. Stellantis, as we mentioned, is also down today, 24%. They're taking a big hit on changing their EV strategy. It's a $26 billion write-down. So that sent shares plunging 23.7% or $2.26 per share. Once Upon a Farm is also on the move today. It gained 16.5%. The IPO price of $18 had a nice pop in the trading debut. Let's get to more movers south of the border. Bloomberg's senior equities reporter Bailey Lipschultz joins us now on that. Bailey, we are seeing Bitcoin start to recover today, but has a long way to go.
A long way to go, but if you had this conversation with me yesterday, we would have said, maybe it's over. Maybe we're testing $50,000 next. But as of now, it does not seem to be the case. So Bitcoin recouping a chunk of, if not most of the losses from yesterday. But as you can see, this is a brutal chart. We did see that provide a bit of a lift, maybe a relief rally for some of those companies exposed to cryptocurrencies, MicroStrategy recouping some of those losses, Galaxy Digital outperforming today. We also saw that really showing up in maybe the broader risk on, whether that's investors buying the dip or fearing maybe the fears around the software impact from the latest Claude release being overdone. We saw CoreWeave rallying double digits, Nebius rallying double digits, pretty much everything that had been battered heavily in the last few weeks outperforming today. But again, as you mentioned, same story with Bitcoin, a long, long way to go to get to where some of those share prices were just a few months back.
Okay, let's talk about Amazon. They reported earnings yesterday after the end of the trading day. And that $200 billion in CapEx spending for the year is really hurting shares today. It looks like investors just can't stomach it.
Investors can't stomach it. It becomes a question of, are you throwing good money after bad? Even looking through a lot of the analyst reactions, we've seen pretty much every Mag 7 company talk up how much they want to spend. But $200 billion on our desk, we all kind of looked at each other and said, I don't know what you're spending that much money on. We've never seen CapEx of that magnitude. So when you look at today's sell-off, a really sharp reaction. Again, this is a market that has been rewarding big wins. Obviously, Anthropic is still private, so we don't know what the reception would have been to the latest Claude release. But we do know that the optics around potentially overspending have been under the microscope. And when you look at today's move after yesterday evening's release and the doubling down from management that they are going to keep spending, a pretty brutal sell-off. But again, an interesting week where if you look at the benchmark S&P 500, only down about 0.25%.
Okay, let's get to Stellantis, which we did touch on, the fact that stock is down. They're writing down on EV strategy, but they're writing down an amount that not even GM and Ford had to write down. So tell me how this rolled out during the course of the day.
This was much worse than anyone was expecting. And it's one of those moments where you question, if today's news came yesterday, how much worse does the sell-off get? Because this, for Stellantis shares listed here in the U.S., worst day on history. As you can see, a huge sell-off, as you mentioned, when you compare that $26 billion figure with the likes of Ford or GM. It's a breathtaking amount. Looking through the analyst reaction, much larger than anyone was fearing. The interesting thing when you look at how Stellantis had been trading, similar story with Ford and GM, investors were expecting a write down at some point. These EVs have not been selling like many were expecting. A lot of capital being poured into it, not to draw a parallel, but does show shades of what the downside could be for the likes of an Amazon. But when you look at that number, when you look at that write down, a breathtaking amount, and it really caused investors to rethink where to place their bets within car manufacturers and when Stellantis will be able to really crawl out of that hole, because that is a large number. And again, shares closing in the U.S., worst sell-off ever.
All right, we will leave it there. Bailey, thanks for joining us. Have a good weekend.
Thanks, you too.
Coming up next, Amazon and Google shares, the decliners today, but the other big tech stocks sort of came back to life. We'll take a deeper look when we come back. North American markets rebounded today after a volatile week driven by declines in major technology, especially software stocks. Investors still want to see return on investment from some of the build-out. Let's go to Chad Morganlander, Senior Portfolio Manager at Washington Crossing Advisors. Thanks for joining us today.
Thanks for having me.
So big tech we know is volatile. Are they poised in 2026 to be even more volatile, you think?
I think so. There's going to be at least this expectation going forward about return on your invested capital. And that came up on both calls for many of for the hyperscalers, with Amazon, throwing out a figure of about $200 billion for 2026 of spend. I mean, that's an astonishing number.
It is a very big number, and clearly it has investors scratching their heads. You've spoken about how lopsided the S&P is, but can you explain a bit more? And do you see any beginning of that to change this year?
Yeah, so what we've seen over the last 3 years is this massive run in high beta, high volatile stocks. And many of those are really low quality companies that don't have earnings, or they have very erratic earnings with a lot of debt. And those companies have represented about 80 to 85% of the S&P 500's return. That's betas above 1 over the last 3 years. We expect that will start to broaden out to more of the higher quality names, the ones that are more steady Eddie when it comes to their earnings profile and their balance sheet. This is an anomaly, what has happened over the last 3 years. Typically, there's been an equal distribution between high beta stocks and low beta stocks going over the past 15 years. But the last 3 years have been something really interesting.
You've also noticed a drop in dividend yield. Tell me about that.
Yeah, well, at one point over the last couple of weeks, the S&P 500 hit the lowest dividend yield ever on the history in regard going back to 1885. So you have a market cap to GDP that's pretty much at an all-time high. That doesn't include private companies here in the United States. If you did do that and you included them, it would even look more distorted. You have those dividend yields that are very low. And then lastly, you have credit spreads between high yield bonds and U.S. Treasuries. That's back to a 30-year low. You've seen that 2 other times, back in the late 90s, 1999, and you saw it in 2006 and 2007. So when that happens, risk is really at full speed, and you have to be careful and mindful about risk in your portfolio.
All right, let's get to a few stocks that you like right now. You like Abbott Labs, which is $30 off its high from last year. What do you like about Abbott Labs?
So Abbott Labs has a unique position within the healthcare industry. They do glucose monitors. That has been a real, I would say, a real sturdy and growing business line, growing at around 7 to 8% year over year. And then they did have a disappointment within more of their consumer staple side of the business when it came to baby formula as well as protein drinks. We believe over the long run, though, that the growth rate of 5 to 7% on the top line and bottom line should justify a higher valuation and a higher stock price over a long run. This is a lower volatility company, growing dividend, very little debt, diversified, predictable business line. This one, perhaps one should consider as a core holding.
Okay, let's get to Cisco. Do you think this is a company that's going to benefit from the infrastructure build out going on?
Yeah, that's pretty much the story there. It's twofold. One, data center build out, not only here in the United States, but outside of the United States on more the sovereign side. They do make chips as well, which should be a positive tailwind. And then their traditional business, of routers and those add-on business lines that they supply to corporate campuses, that all has to be upgraded for the next generation of volume, due in part because of AI. So this is trading at a reasonable price at an EV to EBIT around 15, 16 times this year or next year's cash flow. So we actually think that this is a cheap, more safe way of playing the AI build out.
Okay, let me ask you about PepsiCo. That's your third pick here. And I'm wondering about it because we know the obesity drugs are being widely used. People are turning away from some of the sugary drinks and the snacks that they normally would have had in past years. So why do you like Pepsi?
So Pepsi is going to change their structure and their business line to focus on those consumers as well. The company's stock price has come down considerably, due in part for everything that you said. But what I'm noticing from Pepsi and Coca-Cola when listening to their conference calls is that you're still getting a growth rate around 3% or so. And that 3% could kind of surprise on the upside as they kind of lean into more of the protein drinks, as well as snacks that they're perhaps going to be more focused on protein. We think that the expectation for growth is negative currently, the way it's priced. So we are looking at this company as more of a value play. Again, top line's growing at a 2 to 3% level. They may be able to bump that up to 3 to 4%, as well as operating margins are rather consistent with a great dividend. We think that this one overall is truly undervalued, and we'd be owning this as well as a core holding.
All right, Chad Morganlander, good to have you, sir. Thanks for joining us today.
Thank you. Have a great weekend.
We're going to get a trade lawyer's perspective next on Canada's new automotive sector strategy that was rolled out yesterday. Find out what it means for the industry, which has been hard hit by tariffs. Back in a moment. We want to dig a little bit deeper into the auto industry policies announced by the Prime Minister yesterday. It is an effort to both protect and foster the sector in Canada while diversifying away from the U.S. So let's bring in Derek Young. He's a lawyer and a partner at Gowling, a law partner, at Gowling. Thanks for joining us today.
Hi, Morella.
So the move from sales, Derek, the sales quotas to emissions reductions targets, does that make sense to you?
You know what? I think we should see it as part of a broader strategy. It does make sense, but I think we are still very much at the early stages. So really, I think until we see the details, it is something that's worthy of keeping an eye on.
Okay, so is the idea, though, to open the door to other models being included in emissions reductions, which aren't included now? Is that sort of the broader idea here?
I think the broader idea is to incentivize production in Canada. And what we could see from just all of these initiatives is the desire to allow greater access to the market, but as part of that deal, the need for them to also, international players to also invest in Canadian infrastructure and production. So it is a very much, I think, a carrot approach where partners are incentivized to also contribute to the growth of the industry within Canada.
Okay, so right now there's already a emissions framework. Companies can import from the U.S., for example, but aren't being hit by the tariffs from Canada when they do that. Has this policy worked for car makers so far?
I think it's historically, and then I think we should approach this in terms of looking at broad strategies. It hasn't been implemented in a more coordinated fashion, whereas what we're seeing now under the current Liberal government is more of a strategy where everything is really a piece of a larger game plan to build two things. I think two things that we are focused on is diversity and also resilience. Diversity in the sense that maybe a broader supplier base, and also in terms of international customers for Canadian products, and in terms of resilience through cooperation with international partners, maybe having much of the Canadian manufacturing infrastructure improved and upgraded so that they are more competitive internationally, particularly in the EV sphere.
Okay, so what did you hear in the announcement yesterday that would work, as you mentioned, as a carrot towards that?
All right, it's incentivization. So the import permits under the new proposal seem to be tied directly to the extent to which foreign companies are able to invest in Canadian manufacturing. So historically, we are closely tied to the U.S., and that may very well still be the case. But there is now an increased incentive for exporters or importers into Canada that if they want to play in this space or they want to partake in the growth that's in the Canadian sector, they have to contribute and help build the domestic manufacturing. So the best way to do that, and that's what seemingly is the approach, is to allow for import volumes to be tied directly to the amount of investment in Canadian industry.
Yeah, so what they're looking at, and this is not something that they are moving forward with yet, they're in consultation, is an import credit, essentially. If you invest more in Canada, you rack up a certain amount of credit that eventually will mean cash for you.
Correct. And it's a tradable credit. So again, at this stage, and we have to be very careful about this, it is a proposal, but what is likely going to flow from it, if it's implemented, is the idea that the more you invest in Canada, the more credits that you receive in terms of being able to import into Canada as well. So it's directly linked. It is very much a positive reinforcement exercise. So this is really, I guess, a counterpoint to the other approach, which is the stick approach of just imposing tariffs, restricting imports. This is the exact opposite, where you're saying, look,
okay,
we want you in the space, but it has to be worthwhile for all parties involved.
Yeah, the U.S., Washington has a very aggressive policy, do it or else. And I'm wondering how Canada's policy stacks up, meaning would it benefit companies to stay in Canada with these carrots, or is the U.S. has just such a big stick? What does it matter and really not amount to much, considering the strength and just the size of the U.S. market?
Well, that's a really good question. I think what we need to be cognizant of is the strategy that's being proposed is not unique to Canada. The U.S. themselves actually have adopted a very similar strategy. So U.S. automotive manufacturers are increasingly looking to work with partners abroad to build up their EV manufacturing capacity and capabilities. So to answer your question, really, this may very well be an exercise where we speak of Canadian manufacturers, but many of our Canadian manufacturers being historically tied to the U.S., they are also benefiting from this arrangement. So it is conceivable that for many, even for many of our American partners, they benefit from these policies that are being implemented or being proposed for Canada.
Is Canada a better jurisdiction for them to do business, considering the volatility of the U.S.?
Better jurisdiction for whom?
For companies, for example, Japan or Korea, who are making cars and want to make them or are already making them in Canada. Is there an incentive to stay here because it provides perhaps more stability than the U.S.? Is that an incentive for them?
I think historically Canada has been a very stable jurisdiction in terms of policy and regulatory environment. What we need to keep in mind, however, is that relative to the U.S., Canada is a relatively small market. So it may be, there is more certainty, I think, in terms of operating within Canada, but in terms of volume, obviously the U.S. is still the bigger prize. So in that sense, I think it is very attractive for foreign companies to be here, but we should compare ourselves perhaps to middle powers or other EU economies that have similar customer base or similar size markets. The U.S. is roughly 10 times the size of Canada. So it's not a apple-to-apple comparison, but I do agree that there is absolutely incentive to be in Canada simply because of the regulatory and policy stability.
All right, Derek Young, I got to leave it there. So thank you for joining us today.
Thank you.
Coming up, TMX Group beat on profit and revenue in the latest quarter. We heard from the CEO about the results. More in a moment. Here are the stories we are following in the newsroom today. Canada's economy lost about 25,000 jobs in January. Economists had been expecting a gain of 5,000. StatsCan says the country's manufacturing sector was hit the hardest, with American tariffs continuing to weigh on the industry. Now, January's job loss marks the steepest decline since August of last year, but the unemployment rate fell to 6.5% because fewer people were looking for work. Shares of Stellantis down sharply today, over 23%, after the automaker said it's taking a more than $25 billion write-down linked to its shift in EV strategy. Stellantis is also selling its stake in a battery manufacturing plant in Ontario to LG Energy Solution. The plant was established in 2022, and under the terms, LG will hold full ownership of the facility. Reddit posted fourth quarter revenue that beat estimates. The social media company says daily active users increased by almost 20% year over year, and it saw net income rise by almost 255% from the year before. Following the results, Reddit plans to buy back $1 billion worth of shares. TMX Group reported fourth quarter results today. The operator of the Toronto Stock Exchange posted better than expected revenue and adjusted profit. For more, we were joined by John McKenzie, CEO of TMX Group.
The overriding story here is the business delivered in every part of the franchise. So, the capital raising business really started to come back last year. Trading activity was up double digits across the board, and our global insights, data and information business was hitting new records. So this was not only a record quarter for TMX, it was a record year, both in top line growth, and double-digit EPS performance. So across the board, we're thrilled with what we've been able to deliver. It allowed us to do a 9% increase in our dividend as well, relaunch our stock buyback. So I think it's something that the stakeholders around TMX can be very happy with.
Now, TD has a buy on your stock, but says there are AI concerns. And your biggest source of revenue in the latest period was global insights, a.k.a. market data. It does look as though investors are worried that that could be cannibalized by AI.
Yeah, I think, though, unfortunately, that the investors have got a misunderstanding of the nature of our business. And so let me clarify for you. You're absolutely right. About 41% of our business last year was in global insights, which is all of our information businesses. But unlike some other the software-type companies that have been caught up in these challenges this week, our business is very much a proprietary business. And so our data and information is about proprietary data like TMX Data Links that has market data you can only get from us. Our Trayport business is our energy market, which aggregates on a proprietary network. Our Vetify business is about benchmarks and indices, which, again, are proprietary to us and embedded in products that investors use. So these are actually very difficult to disrupt with AI technologies. And the organization like us is obviously looking at AI technologies in terms of how do we actually get more competitive and more efficient in terms of how we bring these products to market. So on the Trayport piece I mentioned, we are already embedding AI capabilities in there to be more productive in how we bring the product to market. That's allowed us to do more with the same resources year over year. So I do really think that this is a misunderstanding of the nature of our business. We're not a software sales business. We're a proprietary information business.
And then your second biggest source of revenue, well, capital formation equity was big at $82 million. Tell us, and then derivatives, of course, was the next biggest, $115 million. Tell us what derivatives you're big in these days, John.
Yeah, the derivatives business for us has been fantastic in 2025 and will continue to be strong in 26. It's very much a mixture of things that are retail-oriented, like ETF options. ETF options have had phenomenal growth, up 80% year over year. But we're also very strong in fixed income futures, which investors all around the world use to get exposure to Canadian dollar or to hedge those positions. And over the last number of years, we've been adding a lot more product to that. So things like 2-year bond futures, short-term, long-term, to ensure that whatever exposure an investor is looking for, they can get it on the Montreal Exchange. And that's allowed us to grow double-digit year over year. And the results we've had into Q4 this year has been, again, a record quarter in terms of use of those products by the industry. So it's a real kudos to the team here that have really engaged with the industry, understand what the product needs are, and put products on market that are going to help them with their investment experience and their objectives. So you're going to continue to see that strength in 2026.
Just maybe we can put up a 5-year chart for your stock, because it did hit record highs there last summer and then drifted down. And we've talked about the most recent sell-off, which is not unusual. I mean, not unique to you. London Stock Exchange shares fell this week. But why have the shares, would you say, broadly speaking, come down from August?
Yeah, and I never want to be really engaging in what happens on a short-term basis. We're always in this for the long term. I'm a big believer that we should be moving to semi-annual reporting as well, so that we have investors focus more on long term. But if you actually look at the results of the peer group, like all these exchanges and data companies that we're talking about today, over the last 3 years, TMX continues to be one of the strongest performers globally. And that's from not just a share price standpoint, but from a business results standpoint. Revenue growth, margins, EPS expansion. So we're not taking anything from this near-term downturn. We're focused on our long-term strategy. I believe it's going to play out in the long term, and the investors are going to come back to TMX as well.
John McKenzie, CEO of TMX Group. We're going to take a quick break. Back in a moment. Did you ever wonder how the Super Bowl got to be as big as it is? How tickets and ad revenue started spilling into the millions? Bloomberg's Randall Williams breaks it all down in his first episode of Sports City.
Bags are packed. I'm ready to go to San Francisco. Super Bowl week is always crazy, but I'm ready. Let's go. I'm Randall Williams, a sports business reporter at Bloomberg News, and I'm taking you inside the world's biggest, flashiest, and most expensive sporting events to answer one question. How did sports become this big of a business? Today, we're headed to the single most watched event in American sports. Welcome to the Super Bowl. Now, using the word big to describe the Super Bowl is an understatement. Last year, in a blowout win that no one saw coming, Super Bowl 59 became the most watched TV broadcast since the 2024 Super Bowl. And Super Bowl week didn't just dominate TV screens. It generated $1.25 billion in economic impact for New Orleans and the state of Louisiana. This year, for just the third time ever, San Francisco is hosting the game with NBC handling the broadcast. And the hype is palpable, with the New England Patriots reaching their record 12th Super Bowl and the Seattle Seahawks looking to avenge their Super Bowl 49 loss. But here's the thing. The sports business doesn't wait for storylines. Before this season even kicked off, NBC had already sold 90% of its Super Bowl ad inventory at an average cost of $8 million for 30 seconds, a record high. So how did we get here? Let's rewind to the origin of how this event came to be. The game originally got its name in 1969 during the third ever Super Bowl. Late Chiefs owner Lamar Hunt jokingly called the championship the Super Bowl after watching his kids play with a toy called the Super Ball. And right in the middle of the football season's grand finale was entertainment. The halftime show started with marching bands, but that changed in 1993 when Michael Jackson took the stage. MJ's performance brought the show millions of viewers and its first ever sponsor, Frito-Lay. Now the payoff for artists is massive exposure. With two major audiences, football and music fans, the Super Bowl has become prime real estate for advertisers. Everyone has a favorite Super Bowl moment. A favorite game, a favorite halftime show, a favorite commercial.
Remember when Britney stole the show in 2001?
That's why the Super Bowl is unmatched, why broadcasters paid billions to air it, why advertisers paid millions for seconds, and why team owners are rebuilding their stadiums, chasing the chance to host it. Because for one Sunday a year, football isn't just a game. It's the biggest business on earth.
For some people, the Super Bowl is really about the commercials. They're tuning in for that. For more on the biggest ads this year, ABC's Sam Champion has a look at what to expect.
With just 2 days to go before the big game, the battle off the field is heating up.
Instacart lets you choose your bananas from Queen to Extra Ripe.
With this year's ads going big on weight loss drugs,
healthier on Roe,
sports betting,
I'm making my bet on who's going to win,
artificial intelligence, and celebrity heavyweights.
I need a man.
Build him. Give me now like you don't believe. Studios didn't believe. Networks didn't believe. You know who believed? Duncan.
And Duncan is back, with Ben Affleck teasing an all-star lineup that includes Jennifer Aniston, Matt LeBlanc, and Jason Alexander. In for Uber Eats, it's Matthew McConaughey.
It's all food, Bradley!
Torturing Bradley Cooper with Parker Posey dropping in. Uber Eats trying to take the ad from the TV screen to your second screen with a build your own commercial inside the app. And even more stars pop up there. Competitor Grubhub joining the big game with its first ever ad starring George Clooney.
Grubhub will eat the feed.
And watch Kendall Jenner swinging in for sports betting, torching all her exes along the way.
Do you like this bad boy? Boyfriend 2 flopped right out of the league.
But I don't speak Spanish.
Melissa McCarthy taking the ad assignment seriously, even learning Spanish for her telenovela-themed Super Bowl ad for Elf. Well, kind of.
Soy un baño.
And much like the Crypto Clash ads of a few years ago,
Play my Beast Mode playlist.
Okay.
AI ads are facing off this year, with AI company Anthropic taking aim at its competitor, OpenAI. And a Super Bowl classic is back, Budweiser and those beautiful Clydesdales with a new take for their 150th.
You crying?
The sun's in my eyes.
All right, February, of course, is Black History Month, a time to mark the accomplishments of Canada's Black community. Let's do that with Wes Hall, founder and CEO of Kingsdale Advisors, founder and executive chairman, Wes Hall Investments. Thanks for joining us today.
Marilla, thanks for having me.
You must get asked all the time, what do I need to do to succeed in business? I'm wondering what advice you give to young people who come to look for that advice.
Well, that is a great question. I get it all the time and the reason why I get it so much is because Black people have such a hard time accessing capital, really, really difficult. You know, when I was 23 years ago, when I started Kingsdale, I had a house which had equity on it. And I tried to mortgage the house to start Kingsdale, and not a single bank in this country would loan me the money. Not a single one of them. And I was fortunate enough that I went to a bank and there was a Black man sitting behind the desk that had authority to loan money. And I showed him my business plan. And by the way, his bank turned me down. I showed him my business plan and he goes, I love it. Leave it with me. And I was able to borrow $100,000 against my house to start Kingsdale.
Wow.
And I was pretty fortunate for two reasons. One, that I had a home that I could leverage. And two, that day when I went into the bank, somebody who looked like me was there and understood me.
Yeah.
And so that's the problem that we're having today, that there's really not enough folks at the level where they can meet a Black business person, get the passion that they have, understand the various challenges that they face, and actually give them that opportunity of a loan.
Okay, so let me backtrack for a moment. You said you were turned down by other institutions many times. Did they give you a reason as to why they were turning you down?
They said my business plan was too risky, you know, and after analyzing the business plan, so here I am setting up a business that was going to deal with activism on Bay Street. And activism didn't really exist at the time. It was coming, but it didn't exist at the time. And I said, I'm going to be this guy who's going to advise publicly traded companies, CEOs and boards, on how to deal with activism in Canada. Now, you got to understand, why was that business plan so risky? Today, it's certainly not a risky business plan, but back then, I was a 34-year-old Black man. I was going to go into white boardrooms that were no Black people in boardrooms at the time. There were no women in the boardrooms at the time. And I'm going to advise them on how to deal with something that's not going to come yet. And so my passion, I hope that would have sold them, but it didn't. I hope that the fact that I could leverage my house and they can get their money back by selling my home would have convinced them. But the risk that they saw was that they just didn't see someone looking like me taking on that opportunity.
Okay, so let's talk about how you pay it forward, I guess, when you finally met someone who was willing to take your plan and make it happen. You invest in Black businesses. We Shall is the way you do that. What do you look for when you're deciding on who and what ideas to invest in?
Well, first of all, that's a great question in terms of why did I decide to set up We Shall? We Shall doesn't just invest in Black businesses. We invest in underserved entrepreneurs and other businesses, right? Why do I say underserved entrepreneurs? Immigrants are underserved entrepreneurs. They come into this country, they have no credit, they have no establishment, they have no relationship, no connections, they have nothing, right? And all they have is their idea and their passion. And so what they want is for someone to actually listen to them and believe in them and give them an opportunity. And in some cases, It may not be money that I provide to them. I could provide them with mentorship. And that's really critically important to them, that they have someone who believes in them, that they can actually call and run ideas by and can get objective advice without any, without any judgment. And that's what sometimes these people have, is that they come into the country, they may have a very thick accent, and people go, I'm sorry, it's just not going to work. Your accent is too thick. Oh, it's not going to work. You're new to Canada. You have no connections. They tell them all the reasons why it's not going to work. Well, I tell them the reasons why it can work and the things that they have to do to make it work.
Okay, but that being said, I'm sure you don't have a lot of time in your schedule to take on a lot of people, and you don't have endless capital to hand out. So how do you choose the people that you work with?
Well, listen, if you watch me on Dragon's Den, you probably would see that people come with all kinds of ideas, and the people watching television go, man, that's a good idea, or that's a bad idea. And all of a sudden, they get a deal. And they're wondering, what do you see? What does the dragon see in that person? Why they invest in them? Entrepreneurs tend to see things that most people don't see. They tend to ask questions that most people don't ask. And, when you're venture investing, by the way, you're going to lose a lot of money. But probably 10% of those are going to be home runs where you're going to make a lot of money. And that's the reason why venture investors exist. They know that 90% of what they invest in is going to flop, but that 10% is going to make them gazillionaires. And so they look for that 10%, but they continue to invest in that 90%. Okay, so what do I look for? I look for somebody who's so passionate about what they're going to do, and somebody who's willing to risk everything, just like I was willing to risk my house to start my business because I was so passionate about it. And I believe that if you help somebody like that, whether not you provide them with capital or advice, you know what? If that business doesn't work, they're going to pivot to something else that's going to work. And that's the passion about entrepreneurs. They never, ever give up. They never do. They either pivot their business or they just keep on going until it works. But they never, ever give up. And those are the entrepreneurs I look for.
So it's definitely more about the person than it is about the business for you.
Yeah. Yes. Listen, when you're looking at an investor, because you could have somebody with the best business idea, but they're just terrible individuals, right? They are not transparent with you because you're not in there running their business, right? They're not transparent with you. They don't show the books. They're not open, all those things. And they could have a great business, but if those are their Achilles heel, I'm not going to invest behind somebody like that. I have to be absolutely comfortable with that entrepreneur. And also, some entrepreneurs just don't take advice. You could give them the best advice in the world, and they will not take it.
They think they know better.
They think they know better. Don't worry. I know you've been in business for a long time. I know you're successful, but I know more than you, and I'm not going to listen to you. And you can tell those entrepreneurs immediately, as soon as they open their mouths, you can go, I am not going to give you a penny. I don't care how great you think your business is. But I think, Marilla, the issue is for Black entrepreneurs, right? There's 144,000 plus Black businesses in this country. They represent 2.4% of all businesses in Canada. That is a massive opportunity, right? But here's the problem. The problem is that most of those entrepreneurs has a problem even getting $10,000. 10 grand to do something. And that is the challenge, right? If the banks won't loan to them, venture capitalists won't loan to them, fintech won't loan to them, where are they going to get the capital from? In addition to that, Black men like me, we make 6 to 9% less than our white counterpart, right? And our unemployment among Black men is 14% in this country. So if I don't have a job to start my business and nobody's loaning money to me, how do I get started? How do I get going? And that's the difficult aspect of what these businesses face.
Yeah, just getting that foot in the door, as we say. Wes Hall, I'm out of time with you, sir. Great to have the conversation, though. I appreciate your time today.
Really, thanks for having me.
Coming up, we're doing a tech roundup featuring Canadian tech company Wabi. We'll talk about Apple's new acquisition as well. Back in a moment. Let's do a roundup of a week in tech with Carmi Levy. He's technology analyst and joins us now. Carmi, big acquisition for Apple, but for a company that doesn't make money. Explain.
Yeah, it seems kind of surprising. The company's called QAI. They're based in Israel, and they make technology that embeds optical sensors into smart glasses or a wearable device, and it reads your facial expression, so your face, your skin, your jaw, and it can actually tell what you're trying to say, even if you're whispering, even if you're not making a sound. And this is particularly important. It uses artificial intelligence and machine learning, some very advanced technology here, and so essentially what they're doing is they're buying the capability because they're going to have an update to Siri, an AI-powered update to Siri soon, and they want to make it easier for Siri to be used in environments that might be noisy, might be more difficult, sort of where it doesn't work today. And so it's a fundamental technology. This is a company who they're essentially acqui-hiring their leadership, bringing them on board, giving them the AI smarts to create more AI-driven interfaces like this that will power the Apple Intelligence services that they've been struggling to bring to market for the past couple of years.
Yeah, so it sounds like Siri is going to now speak for me, which is creepy, but hey, that's the future. Okay, let's get to Elon Musk bringing together SpaceX and xAI for the IPO. What's the benefit here?
So the benefit here is it's almost like Starlink, because Starlink has given sort of SpaceX an opportunity to ramp up its launch capability and use that in-space service to fund its operations. Kind of the same logic here as well, is that Elon Musk is banking on AI being the very future of SpaceX. And so xAI provides, they have the Grok platform, provides an AI platform that powers SpaceX's operations, also gives them a reason to launch even more satellites, data center satellites, into orbit. Elon Musk, of course, has been talking about not building out data centers on Earth because you got to get the land, you got to get the approvals. Nobody wants to be next to them. Instead, you put lots of them out in space where there's limitless solar energy, no worries about power and cooling. And he's even applied to the FCC to launch upwards of 1 million of these over the next number of years. And so in advance of the expected SpaceX IPO later this year, Elon Musk is hoping that by combining these two, that there's this kind of symbiotic relationship between them. It provides that next opportunity to drive SpaceX to kind of the next level of scale as its Starship launch capability comes on stream.
Yeah, it's so hard to think about that concept yet, but for him, I guess it must seem like a reality that he's moving towards. Let's get to Wabi as well, a Canadian company that has some technology that is very interesting to many of the big tech companies, and now it's signed its contract. Remind us about it.
So they're going to provide at least 25,000 vehicles to Uber for its autonomous vehicle ride-sharing services across the continent. They're already operating in a number of cities in the U.S. We know that negotiations have begun to bring that to Toronto as well. Their kind of party trick in terms of technology is they don't just train their vehicles on the road, they also train them in simulation, collect a lot more data about what works and what doesn't. And they're already using it for transportation, 18-wheelers on roads in Texas. They've been doing this for a number of years in partnership with Uber Freight. So this is a company that is, kind of been in stealth mode for the last little while, only been around for a little over 5 years, but it has a technology that companies like Tesla, General Motors, even Google with its Waymo unit have struggled to scale into the real world. And so far they seem to be, the vehicles are not crashing into emergency vehicles. They're not crashing into 18-wheelers. It's technology that just works. And this is the biggest bet that Uber has made on this technology. And it's coming from a company that no one has heard of before.
And you mentioned that at some point they will be coming to Canada, because we see all the trials that are happening in the U.S. and definitely places where there are warmer climates.
Absolutely crucial to get that on-the-road experience in a northern climate like Canada, because we're going to learn things here that you can't when you're in Austin, Texas, or Miami, Florida. And so a Canadian winter is going to push this technology even further. They'll use that information to further advance it and make it even more reliable and robust. So absolutely crucial use case. And as always, it's Canadian technology that seems to be at the center of it.
All right, Carmi, got to leave it there, sir. Thank you for that, and have a good weekend.
Thanks, Marella. You too.
Let's have a last look at how we ended the markets for the week. It was a volatile one, but the market did end the day up, with the TSX climbing 476 points, up 1.5%. The S&P and the Nasdaq also doing better today. Thanks for joining us today on The Close. We'll see you back here on Monday.